Paul Van Eeden, president of Cranberry Capital and a speaker here at the show. Paul, thank you so much for being with me today.
No, it's my pleasure. Thank you.
So you were speaking to a standing only crowd. Congratulations on that. But you got some tough questions.
Yes, we always get tough questions. That's what makes these workshops interesting.
Right. Well, I think part of the reason is you're not maybe saying everything that people necessarily want to hear. So let's start with that. Let's look at your general outlook for gold as we head into 2013.
Well, I'm not bullish on gold. It's because I believe gold is overpriced. The expectation in the gold market is for massive US dollar inflation. And I see no evidence of such inflation when I look at the US money supply or if I look at the expansion of the Federal Reserve Bank balance sheet since QE3. Now, there's no doubt QE1 and QE2 was a massive expansion of the Fed balance sheet. But that expansion in the Fed balance sheet did not translate into direct U.S. money supply increases. In other words, we didn't see the increase in U.S. inflation.
Okay.
I also don't think we're going to see that. So I'm not at all concerned about runaway U.S. inflation. Therefore, I believe that the gold market is overreacting and is overpriced.
Okay. Are you bullish on the U.S. dollar?
I am bullish on the U.S. dollar, but for a very different reason. I think that the United States has dealt with its financial crisis already to a large extent. It's ahead of Europe. I think China has big problems in both its economy and in its banking sector that still has to come to light. So on a relative basis, if you compare the United States to the other large economies in the world, the United States is in better shape.
Okay.
But more importantly than that, the United States has some of the lowest, if not the lowest, wholesale electricity prices in the developed world. It also has a large available pool of labor as a result of high unemployment. It also has available capital at reasonable prices. So the United States has all three key ingredients that you need for economic development: available labor, available capital, and available energy.
So, Paul, let me ask you, when you say gold is overvalued, what do you think the real price should be?
Well, that's a tricky question, right? Price is not the same as value. I think gold is worth somewhere between 800 and 900 US dollars an ounce.
Okay, so that's fair value.
Correct.
Okay.
But that's not the same as predicting gold is going to imminently decline to $800 or $900 an ounce. It's just that when gold is at $1,700 an ounce, and I believe it's worth $800 or $900 an ounce, I have no interest in buying it or owning it.
Okay. But despite this, you still believe in exploring for gold. I know you sit on the board of Miranda Gold, so there's still a belief system in the system.
Absolutely. My business is investing in mineral exploration companies, and I'm a gold bug. I'm just not always a gold bull.
Okay.
So I have a predisposition, an affinity for gold and gold exploration. The reason I invest in gold exploration stocks, in spite of the fact that I'm not bullish about gold, is that if we make a discovery, there's a value creation step in the discovery process, and that's not dependent on the price of gold.
Right.
Yes, if the price of gold is higher, then whatever we discover is worth more. But it doesn't detract from the fact that if we have no gold today and we discover gold, that we will make money in that value creation step. And that is what I'm investing in.
Even if gold were to drop back down, let's say to 1,000.
Absolutely, because the gold mining industry will still need new gold resources to replace their mined reserves.
Right.
And so there'll always be a demand for new gold resources being discovered. We'll always be able to sell a good gold deposit.
So on that note, Paul, yesterday I was speaking with the CEO of Miranda Gold, Ken Cunningham, and I thought it was interesting, and I admired his honesty, because he's quite bearish on the industry. And I thought that was different to see a CEO who was that honest and not really bullish.
Yes, absolutely. Ken is a very honest individual, but in addition to being honest and trustworthy, he's also extremely capable. If I look across the mineral exploration industry, there are very few management teams, which involves Ken as the CEO, plus their VP of Exploration, Joe Aber, and the whole team that sits and supports them. They are an extremely capable group of people. And that's why I continue to support them, or I continue to invest in them, and why I agreed to be on the board of Miranda Gold. I trust them and I have confidence in them.
Paul, let's switch topics a bit. Something interesting that came up was this aspect of the gold-silver ratio. That's one of the most popular questions I receive. People ask me, how does that work and why we should be paying attention to it. But it's interesting because you're kind of saying, let's just throw that out the window.
Well, absolutely. Well, first of all, if you look through history, There are periods in which the gold-silver ratio appear to be static, and most of those periods are when it is static by decree. If without that decree, without that legislated ratio between gold and silver, there is no static ratio between gold and silver, and nor should there be.
Okay.
Gold and silver occur in different abundances. Gold and silver are produced in different quantities. Gold and silver are not used for the same purposes. Gold is essentially a monetary asset. Silver is entirely an industrial commodity. So there is no logical or philosophical reason why gold and silver should have a fixed ratio.
Paul, are you buying physical gold right now?
No,
Okay.
absolutely not.
And do you plan to?
No, not while gold is at $1,700 an ounce.
Okay.
You know, my investment philosophy is very simple. I like to buy things low and sell them high.
Okay.
That's easy said. It's very hard to do. But in the case of gold, it's trading at $1,700 an ounce. I believe it's worth $800 or $900 an ounce. It would be absurd of me to be buying gold if I think it's trading at double what it's worth.
Okay.
If gold falls and its price is below what I think it's worth, I'll be buying a lot of
So
it.
what price would it need to fall to in order for to get you back into the game?
Well, it depends on when.
Okay.
If it was today, it would have to fall to below $800 an ounce, but it's not going to happen. I'm not making a price prediction. Remember, I'm not saying gold is going to
Right.
imminently decline. But if you go back to the 1980s, gold peaked in 1980. It took 15 years of declining gold prices before the price of gold matched up to its value.
Right.
15 years. I don't know how long it's going to take this time. Maybe gold goes up from here. Maybe it doesn't. But what I do know is with gold trading approximately double what I think it's worth, I have no interest in buying it.
Finally, Paul, something else that came up that wasn't so popular was with the audience was your view of the Fed and how you said that you think Bernanke has done a good job up to now.
Yes, absolutely. Now, you have to understand, I'm not an apologist for the Fed. Philosophically, I don't agree with fractional banking. But we don't live in a world where my philosophy matters. We live in a world in which we do have fractional banking and we do have a Federal Reserve Bank. When the financial crisis hit in 2008, there was a very real threat of monetary deflation. The Fed averted that with QE1. In 2010, that threat of monetary deflation appeared again. It was very real. It was severe. The Fed averted that with QE2. There was no such need in QE3. There was no threat of deflation at QE3. But if you look at the Federal Reserve balance sheet, you'll see that since the announcement of QE3, their balance sheet has not really expanded at all. And so the Fed appears to be sterilizing QE3 by selling assets at the same time as they're purchasing assets. And if you look at the whole management of the financial crisis since 2008, I do believe that Bernanke has done a superb job within the context of what his job description is.
And Paul, were you saying that it's just not plausible for interest rates to remain at these rates, that eventually they will rise again?
Yes, absolutely, because interest rate is the price of debt. And in the United States, we have too much debt. So ultimately, the debt in the United States is going to cause upward pressure on interest rates or downward pressure on the price of debt.
Okay.
Now, at the moment, the Federal Reserve is intervening in the markets to keep long-term interest rates low. So they're buying longer dated securities and selling shorter dated securities. At some point, that whole process will come to an end and interest rates will rise. I don't see that as a problem. I think the United States economy is going to cope perfectly well with it, but it will happen.
Okay, good. Paul, thank you so much for your thoughts today.
Thank you very much.
And thanks for watching our coverage from the San Francisco Hard Asset Show. You can email me any comments or questions at newsfeedback@kitco.com or tweet me at Daniela Cambone. Thanks for watching.